And good morning once again to all of our options traders. Well, topic for today for everybody who likes to trade spreads. Good little piece of information that can help you have better understanding about strategies and also where your max gains are going to occur. And the question for today, what's significant about the short strike? For any type of spread, there's something that happens at the short strike that doesn't happen anywhere else. And we're going to find out it creates kind of a unique situation that's kind of handy to know. So let's go find out more about this. What's significant about the short strike? As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and definitely helps to promote the channel. So let's start off with a basic definition of spreads. Now, there's the real common one that most traders think is what defines a spread, but there's actually a better definition. So, a basic definition that most traders live by is that for a spread, you are long an option and short an option of the same type, meaning that you have two calls or two puts, such as with a vertical spread. But there's really a better definition to go to a higher level of understanding with strategies, and that is that you have opposing deltas. A spread just really means that you're long an asset and short an asset, but that they have opposing deltas. So we'll look at some examples in a moment, but that's the one that I want you to think of for this video. But the thing that you have to understand is that for any spread, the short strike is the point where a dollar gain is offset by a dollar loss. And that's why you're going to flatten out on that risk graph, or at least not continue in one direction or the other. And what's important about this is that it is the point of maximum gain, and that will always be true. So as you're developing more advanced strategies or kind of experimenting with different strategies, it's a real easy way to figure out where your maximum gain is going to occur, but we're also going to find out why. So let's start off with a simple one. Let's look at a 100-105 vertical call spread. So we'll start with a debit spread. It's a bull spread. So let's say that you buy the $100 call and you sell the 105 call. Now, I point this out in just about every video. Remember, we get bends at these strikes. So there's our 100 strike, there's our short 105. But notice that if we just had the long 100 call, we would have this type of a risk graph. We have positive deltas here. But once we hit the strike of the short, what happens? We flatten out. And that's because at this point, every dollar that's being gained by the $100 call is being offset by a dollar loss in the short 105 call. And so that's where your maximum gain is going to occur. Now, this is a debit spread. What if we did a credit spread? Well, let's stick with a bull call spread, but we'll use puts. If we use puts for a bullish call spread, it's going to be a credit. So now let's say that we sell the 105 put and we buy the 100. Still get our bends at these strikes, but notice what's going on here. We have sold the more expensive option. This is the controlling option. So if we just sold this put by itself, that would be the risk graph. However, even though we have sold a put, notice that this line right here is leaning to the right. It's looking like shares of stock. So it actually has positive deltas. And so if we have positive deltas matched with negative deltas, which is what a long put has, we will flatten out. But notice this is the strike of the long position. We bottom out here. See, if we have gains in this direction, it's a bull spread, but the gains are now limited by a short strike. So we know that every dollar gained is going to be offset by a dollar loss. This has to be the point of the maximum gain. So again, that's going to be true. Now, this is typically what people think of when you talk about spreads. They think of vertical spreads. But remember, when we looked at our previous definition, it's really being long and short an asset that have opposing deltas. So for instance, let's look at a covered call. A lot of people don't think of a covered call as a spread, but it is. It fits our definition. So this is where you're going to buy shares or perhaps already have them in the account, and then you sell a call against them. So again, notice that the covered call isn't two different options, but don't let that throw you. It's long something and short something, and they have opposing deltas. All right, so that is something that the covered call does have. We've got long deltas here on the shares, but we have short deltas on the short call. And so again, the short strike will be the location of the maximum gain. So here is the risk graph for long shares of stock. Now remember, when we talk about positive deltas, I briefly mentioned it before, we have this line leaning to the right. And all that means by having positive deltas is that as the stock price rises, you are making gains, but as the stock price falls, you are taking losses. Positive deltas just means that they move in the same direction. Stock price up, profits up. Stock price down, profits down. That's what it means to have positive deltas. So we know that long shares of stock have positive deltas. But if we overlay a short call by itself on top of this, now we can see that we have opposing deltas. Now notice if we zoom in on this graph right here, do you see how at the strike right here that we get this little X? And that's showing us, if you look to this left part right there, as this black line is increasing, those are the long shares of stock, that they are being opposed by this red line, coming in at the kind of the same angle, but it's negative deltas. But over here to the right of this crossing point, we get the same thing. Black line is increasing, red line is decreasing. And once you get that X, even way out here to the right, it just shows that $1's gain is being offset by $1's loss. And so that's why we get this symmetrical pattern out here. So now we can see that at this strike price right there, we have $1 gain is being offset by $1 loss. And that must be the location of the maximum gain. So if we take the long shares of stock in black and we also have a short call in red, and we put them in our account, what's going to happen? We get this. There's our classic covered call risk graph, synthetically the same as a short put, but look at where the maximum gain is, right there at the strike of the short. So for all stock prices above here, you cannot do any better. Why? Because at that level, your long deltas are being exactly canceled by the short deltas. And for every dollar you're gaining in the long stock position, you are losing on the short call. And that's why this risk graph flattens out for all stock prices above the strike. All right, so what about for other types of spreads, such as maybe a calendar spread? Well, a calendar spread, recall, is where you're going to buy a longer dated option and sell a shorter dated option of the same type meaning that both are calls or both are puts. So for instance, let's say that you buy a March 100 call and sell a January $100 call. Well, again, we have opposing deltas. The long March call is going to have positive deltas. The short January call is going to have negative deltas. And what does that tell you? The short strike is going to be the location of the maximum gain. And so if we were to look at this position on a risk graph at expiration of the shorter term of January, this would be the risk graph. And notice what we have. Right there at the strike is the maximum gain, the point where the dollar gain is being offset by a dollar loss. And that will always be the strike of the short. So this will always be true for any type of spread. But you have to be careful, and I see a lot of new traders making this mistake. They assume that the strike of the short for any strategy is going to be the area of maximum gain. Well, that's if they have opposing deltas. So where could this backfire? Well, let's say that you have long shares of stock, you have positive deltas, but you sell a put on top of this. And if you sell a put, what do you notice? You've got positive deltas here in black, you have positive deltas here in red. That's not opposing deltas. That's not going to create an area of maximum gain here at the strike. Instead, what's it going to do? It's going to accelerate your deltas. You've got 100 deltas here in black, but when you combine these, the black with the red, you're going to have 200 deltas below the $100 strike right here. So watch what happens if you are long shares of stock and short the 100 put. See, now you do this. See, that's not going to be the area of maximum gain. And this is because you still have unlimited deltas out in this way. They are not opposing deltas. But for any type of spread where you have opposing deltas, and that will That'll become second nature as you continue to work with strategies, but it becomes a real easy way to figure out what your risk graphs are going to look like and where those maximum gains are going to occur. If you have opposing deltas, it is the strike of the short that is going to show you where your maximum gains occur, and that's because that's exactly where every dollar gain is being offset by a dollar loss. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsA2Z.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.